viewers, and welcome to our event today, the Philippine REIT Landscape,
brought to you by FirstMetroSecurities in partnership with the Philippine Stock Exchange and DBS Group Research.
I'm your host, Danie Laurel, and I am hoping you find this session meaningful and valuable for your stock trading journey. Now today we will be taking a deep dive into REITs. Those are of course real estate investment trusts. And while you may already know about REITs, today we will be learning so much more about them from our presenters and panelists. Now in just a bit, we will have Derek Tan. He's the Executive Director and Head of Property Research over at
DBS Group Research,
to present a macro view of REITs. We also have with us later on Attorney Roel Refran. He is the Chief Operating Officer of the Philippine Stock Exchange with a more personal view of the REITs journey here in the country. We're also joined by our panelist, Peter Bautista, Head of the Institutional Sales Department of First Metro Investment Corporation, and Marco Tarog. He's the Business Development Officer of First Metro Securities Brokerage Corporation, who we will meet and talk with later on. I hope the insights that we learned today can be of great value to your stock trading journey and inspire better appreciation of real estate investment trusts. Now, if everyone is ready, let's get to know more about our first presenter, Derek, and his global view on REITs. Now, over the past 14 years, Derek has helped to raise the profile of the Singapore Property Research franchise for DBS and has been involved in various IPOs within the property and REIT space. Derek has been consistently ranked as the top real estate analyst in Asia Money polls and has been regularly quoted by the media for his views on the real estate sector. So thank you, Derek, for sharing your time with us today. We look forward to your presentation.
Thank you. Thank you for having me today. And I'm very excited to share with everyone on the outlook for REITs in Asia. REITs has been in Singapore for a long time. I think the first REIT was listed back in 2004. And it has been a remarkable journey for me. I've been an analyst for more than 15 years, and I only look at REITs and property. And since then, we saw the REITs starting with just one. Now in Singapore, there's 42 REITs in Singapore. And in Singapore Stock Exchange, every 10 stocks that's listed in the market and traded every day, one is actually a REIT. So it tells you that it's a very robust and growing sector. And we are very happy that Philippines has gotten into the REIT bandwagon. And we expect to see many years of hopefully good profits and trading opportunities for investors. Can we go to the slide, please? So let's look at what is a REIT. So firstly, I think for investors investing in a REIT, I think a lot of investors do ask, why do we buy REITs rather than equities or bonds? I think the good thing about a REIT is that they possess characteristics that lie in between an equity and a bond. They give investors regular dividends. And in Singapore, we generally get about half a year semi-annual dividend payout ratios. On average, returns about 5 to 6% dividend returns, and they are traded like an equity at any time, at any point that you are feeling more positive, or let's say you're getting more cautious, you can easily trade in and out of a REIT compared to, say, a real estate. Earnings are backed by real estate leases, very stable, and it's something that's fairly similar to what a bond instrument offers, stability in income. But in my view, REITs are better, because dividends can continue to grow in line with economic growth momentum. Let's look at the REIT market next. The REIT market in Asia is growing, and in Singapore, it's the second largest REIT market after Japan. So there's 42 REITs here, about close to 114 billion in terms of market cap. We have all kinds of REITs listed here, ranging from properties in offices, retail malls, hotels, healthcare, hospitality, you name it, we have it. And we believe that it is something that investors continue to like and invest in through economic cycles. And I think there is that opportunity, in my view, for Philippines. If you look at the particular table on the left, you find that Philippines now only have 3 REITs, and I think there's many in the pipeline. And if we take a 10 to 15 year view, I do see Philippines growing to as large as some of the key markets that we see here, and potentially will be a key REIT market that a lot of international investors are asking and interested to invest in. The performance for the REITs has been very strong. If you look at year to date across the Asia markets, the REITs have outperformed the relative benchmarks year to date. With the exception of Singapore, we are still in line with where the benchmark currently are trading. And I think the main reason is because since the start of the year, there has been a start-stop in terms of the whole COVID situation in Singapore compared to, say, in Japan, Hong Kong, or even in Australia, where there is increasing progress about how the economy is growing past COVID-19. I think that is something to look forward to in going into 2022. I think REITs generally will be a very strong proxy to play into the recovering economy. Let's look at the next slide. So I think there are many reasons why investors look at REITs, and one of the key reasons is because investors love real estate, and REITs are an inflation hedge. So we have done an analysis, I think over the past 20 years, and we see that REITs generally perform well in a period of higher inflation. So if we look at how the various subsectors perform, we find that the sectors in office and hospitality tend to have a positive or a more correlation with inflation rate, and it's largely due to the fact that earnings, rentals, growth ability, demand are closely intertwined with GDP outlook. So that is something that we believe investors can take note of. That while most investors may look to the physical real estate to buy as inflation proxies, REITs, especially those in office and hospitality, can be your proxy in the listed space. The next question that investors ask has always been about interest rates, and we can find the next slide. That interest rates will continue to rise, but we want to highlight that interest rates increase may not be a bad thing. And the main reason is because interest rates are rising on the back of better economic growth. So we look at where REITs trade relative to the yield curve. So the flattening or the steepening of the yield curve have different impact on share prices for REITs. Most people would say that interest rates are bad, but I think yes, interest rates are only bad if it spike rather than rise. So if you've seen that the historical performance, you find that in periods where interest rates rise, and there's no clear indication that REITs will fall. But in periods where interest rates spike, then that's where the trouble begins. So you'll see a slight disconnect or a slight correction in share prices for REITs, but it tend to be very short-term in nature. In DBS, we are forecasting that in line with Fed expecting to increase or hike rates, interest rates will rise, the yield curve will steepen, but it will be very progressive, gradual. And I think this is something that will not be a big hurdle for the REITs to continue to perform well in the next couple of years. Let's look at the share price performance of REITs in periods of interest rate increase in the next slide. So we did an analysis. We identified there were 12 periods where interest rates spike rather than rise. So what it means by spike is that interest rate, we define it as when interest rates rose by more than 50 bips or more in a very short period of time of between maybe 4 to 6 months. And during those periods, we find that REITs actually underperform the relative benchmark. Naturally, because investors and positioning change, and they typically underweight the yield instruments, similarly like REITs and bonds, and buy growth in the STI. But we also found that this correction tend to be very short-lived, and is also the best time to buy into the REITs. And because if you find that the performance of the REITs after this, when 10-year yields or interest rate stabilizes in the next slide, you'll find that most of the performance, underperformance become outperformance. So meaning that if investors were to take a counterintuitive kind of position and buy into weakness in periods where interest rates spike, you'll find that the returns over the next 6 to 12 months, in fact, you outperform the benchmark. So this is the experience that we had in Singapore. And we've been consistently telling investors that, always take a reverse view on what you hear in the news, especially in the REITs, because they do rebound over time. And that has been a very, very profitable trade for a lot of investors that have been investing into the REITs over the past couple of years. So this is shown back in 2013 all the way down to most recently in the first quarter of this year. Whenever the interest rate stabilize, when interest rate stabilizes, the outperformance for the REITs, they tend to come and outperform after that. And since the first quarter of this year, the same relationship has happened. So REITs have continued to come back in force over the past couple of months. So we move to the next slide, please. So let's look at REITs and the pandemic. And the pandemic has changed in the way of how people live, work, play, and even consume. But we would like to highlight that some are structural, some are cyclical. And I would say that for investors, investing in REITs, it's been very, very profitable, and it can continue to outperform. If you look at how the past 10-year performance, the reason why people buy REITs is because of its dividends and the growth in dividends. If we look at price returns, we are probably up about 40% over 10 years period compared to a 20% increase of the STI. But if you look at you reinvesting those dividends back into the REITs, you find that total returns are in fact up 240% over the past 10 years. So compared to a 160% increase of the STI. So it tells us that REITs, by virtue of the consistent high dividend, growing dividend, is something not to be taken too lightly. And we believe this is the key reason why the REITs will continue to remain a core investment for investors' portfolio. Next slide. So I think what are the key matrix that people look at? Returns have shown historically to be outperforming. But if you look and buy into a REIT, there are a few things that we will tell investors to look forward to. So one is firstly on the sponsor. And I give an example of a Mapletree Group backed REIT in Singapore. So sponsors are important. So, for example, in Philippines, we have the Ayala REIT. Upcoming, we are expecting to see Robinson Land, even Mega World. So, very strong developers are backing some of these REITs. And in Singapore, likewise, Mapletree is a household name. And there are 4 REITs in their staple, and they are trading generally at significant premiums to their respective books. And investors will ask, why is it so? And I think the main reason is because sponsors take a significant stake and a significant shareholder. They give stability and confidence to the REIT itself. Sponsors, offer REITs pipeline for acquisitions through developments, and then that will support a inorganic growth potential for their respective REITs. Stronger relationship with financial institutions together as a group. When they approach the banks, they typically get better financing rates. So this is something that investors should consider when you invest in REIT. Always look at who are the backers, who are the major sponsors. There are certain negatives with regards to having a sponsor REIT. Investors always ask, how do I then make sure that my interests are aligned? But I think that the REIT code in Singapore is very robust. Whatever related party transactions in Singapore have to be only voted by minorities. So it's something that then over time you find that the track record, the way the sponsors have treated the REIT in terms of transactions they've done, you'll be able to get a good sense that whether the sponsors are a good supporter or generally are just selling assets that some of the investors may not want. So I think that's a key criteria that investors should consider whenever you look at REITs itself. The next slide. So in Singapore, I think we have the benefit of having a close to 15-year track record. But over time, I would like to highlight that it's important that big is good. So in Singapore, there is we are 42 REITs. Probably only the top 15 REITs are large enough for institutional investors globally to look at. And the main reason is because of the liquidity. And in terms of size, they will be in major property indices globally and also in Singapore. So very wide following for especially the top 15 REITs in Singapore. And something that I feel in the longer term, we will see more mergers, more acquisitions, and especially for some of the newer REIT jurisdiction to continue to bulk up and grow. In Singapore, we are expecting to see merger to get bigger. And most of the time, every year in Singapore, we are seeing close to 10 to 15 billion worth of acquisitions to bulk up equity fundraising. And as they get bigger and bigger in Asia, more investors will want to be continue to participate in the growth of the sector in a longer term. Next slide. So I think in Singapore, I think there are many sectors that that investors look at, and we talk about sponsors, and I think that the key thing to look out for is that in the various subsectors, they do perform differently in various parts of the economic cycle. So I think investors, are very positive about the outlook for office. Generally, what people are worried about the work from home trend having the impacting demand, but we think that demand for Singapore, especially for a small island for Singapore, should not be a problem, especially when we are largely well connected. Retail malls will be impacted as more people shop online. But I feel that in Singapore, we also know that malls, like in the suburban space, they cater to largely recurring or essential trades, will be more resilient. Industrial is a sector that investors love, and that is where we have the logistics, data center REITs here, with tailwinds from structural growth trends on the adoption of more online shopping, and also more people having demand on connectivity. So it is something that I feel investors continue to want to invest in. And last but not least, hotel, healthcare, very niche in nature. Now things are very, very uncertain, but as borders open in 2022 and beyond, we think that things will start to rebound strongly in the medium term. The next slide, please. So, as I highlight for investors who just purely look at REITs, it's also important to consider the economic situation. So as we go through the economic cycle, different REITs perform or outperform each other. So for example, now we are just at the recovery post a recession last year. So in my view, we are at a point where the market is probably turning and going into a bull market going into 2022. In this period of time, investors should be considering to be investing in sectors that can deliver you faster growth relative to the other subsectors. So this will imply REITs in the office, hotel, and industrial sector. So on a relative basis, we believe that investors investing in this space will probably make better returns compared to, say, retail or healthcare, which is more resilient than growing. Likewise, if we are approaching a market top situation or in a period of late economic expansion, then we will have to switch our preference towards more retail and healthcare. So it's economic cycles, and your choice of REITs is very important to consider, and it's important to switch between sectors as we progress through the economic recovery. Next slide, please. So I think the key thing to note that we'd like to highlight to investors is that REITs at this point in time, while it's up about close to 10-15% year to date, it is not expensive. Still trading at close to NAV. Yield-wise, various subsectors have different level of yields, and it's a function of how investors view the growth opportunities. And I think it's between 4 to 5%. Overseas REITs can offer you between 6 to as high as 8%. It's important for investors to pick and choose. There's certain various subsectors offer you different risk-reward ratio. At this point in time, in our view, we've been telling investors to consider REITs in the industrial, while yields are low, is growing significantly much faster, about between 5 to 10% CAGR per year, and into the office, in view of how we anticipate demand to increase on further reopening of the economy. The next slide, please. So, on the last and not least, I think it's important to also consider that given that REITs pay out most of the cash flow, they depend a lot on the equity and the debt market to maintain their growth initiatives, and also to maintain, they need to have continued access to them. So cost of funds have been very stable. In Singapore, we're tapping the perpetual market. But I think it's important for investors to also note that refinancing risk generally is fairly low. So what we also note that, in REITs in nature only refinance about 20% of the debt per year. Even if interest rates were to rise by 1% in a single year, the actual impact on the REITs is actually very minimal. Moreover, most of them have hedged in their interest rates into fixed rates. And that will mean that actual impact of a 1% hike in interest rates will be even lower. So I would like to reassure investors that interest rates, it's not going to be a big impact as long as you invest in REITs that continue to be able to grow their dividends or revenues faster than the interest rate rise. Next slide, please. So I'd like to end with a successful REIT story. So how does a REIT that started very small now has become a core part of investors' portfolio? So a very successful story in Singapore is this suburban landlord called Fraser Centrepoint Trust. It is generally started out as a very niche exposure. They only invest in suburban malls in Singapore, and over time, the manager or the REIT have been able to deliver you 10 years consecutive growth in dividend, driven by managing the malls properly, changing the mix, and also through acquisitions. Every acquisition they do in various parts of their history, of their listing history, has been accretive to both dividends and to NAV. So as such, over the past close to 13 years of listing history, they are now considered one of the key stock that investors hold in their various portfolio. Very resilient and very comfortable in the way management execute. So for investors to invest in REITs, as I highlight earlier, important to consider the sponsor, important to look at the track record, and once they get comfortable, eventually the REIT will deliver you that very, very stable returns. And for Fraser Centrepoint Trust, I think in terms of relative returns, since they started out, it's more than 4 times the returns. So it is something that I believe that in Philippines there is an opportunity to find such a treasure among the REIT listings that is coming out. So with that, I'd like to end my presentation and thank you for your time.
Okay, thank you so much, Derek, for all of those insights you've shared with us. We will be absorbing all of these insights and taking in all of your discussion points more with Peter and Marco later on. That's a lot to be discussed here. Thank you so much for those very, very informative slides. Now, ladies and gentlemen, we'll get to look at the REIT's journey that is closer to home, literally, as Attorney Roel Refran shows us the REIT's journey here in the Philippines. Attorney Roel Refran is currently the Chief Operating Officer of the Philippine Stock Exchange and is a CPA lawyer with a Juris Doctor degree from the Ateneo de Manila University and an MBA in Capital Market and Finance from Emory University in the United States as a Fulbright Scholar. Attorney Roel has been the longtime REITs champion of the PSE, and I'm sure with many stories to tell, he can paint us a meaningful picture of REITs that goes beyond real estate. So thank you, Attorney Roel, for sharing your time and your insights with us. We look forward to your presentation.
Thank you very much, Danie. It's a pleasure to share the REIT story of the Philippines. And we'll go through a couple of the interesting highlights as we would navigate the economic development that is the REIT story. Whenever you look at real estate, as others would say, it's really a proxy for economic development as well. The more you're able to optimize valuable and finite real estate, the more you're able to create what's called the multiplier effect. Jobs being generated, real estate and other taxes also being generated, essentially creating a multiplier effect. And that has been the primary impetus on why we were able to also convince not just Congress, but also the Bureau of Internal Revenue, as well as the Department of Finance, on the viability as well as on the necessity for the Philippines to have their own version of a real estate investment trust. So in the next couple of minutes, I'll be sharing with you the REIT journey of the Philippines. And then let's do a little bit of FAQ, a deep dive on REIT, some important facts. And then finally, we'll wrap up with what are the benefits not just to the sponsors or the issuers, but as well to you, the investors, when you look at REIT as an investment vehicle, as a new asset class. When you look at the global picture, there have been a lot of REIT jurisdictions through the years. If you look at the US, for example, since 1960s, they have had the REIT in their tax code. And you look at closer to home, right? We did have Republic Act 9856 in 2009. And you look at our other neighbors, India had their REIT framework 5 years later in 2014, whereas the likes of Japan had a much earlier REIT jurisdiction framework back in 2000. You look at, for example, the other neighboring countries, Vietnam had theirs in 2015, Thailand in 2005. No? So in short, there's really wide-scale adoption of what is to be an REIT framework, really simply because it does provide a lot of economic benefits as well as provide investors with a viable opportunity to participate. So it was in January of 2020, right, just before the pandemic, that we did finally have a regulatory framework for REITs. No? Again, Republic Act 9856, the REIT Act. Then we had the implementing rules and regulations by the SEC, together with the Bureau of Internal Revenue regulations for REITs. And finally, our listing rules to allow an REIT corporation not just to be listed, but to be publicly offered to everyone, right? And that is really the magic of an REIT. The fact that it will become a listed vehicle, it will be required to comply with stringent regulations, and in order for it to avail of the tax incentives or the fiscal incentives under the law. And we'll go into a little bit of that in the next couple of slides. All right? Now, what is an REIT? Right? We're very familiar with holding the real estate asset, right? You may want to buy a property. You may want to buy a condominium unit, right? And that's something that is closer to our hearts now when you look at investments. But we know that there will be costs attendant to investing in the real estate asset itself, right? There are taxes that have to be paid on an annual basis. If you do decide, for example, to dispose of that real estate property, you have to pay, again, taxes. You also have to pay brokers' commissions, not to mention the fact that these are really very illiquid assets, right? Illiquidity meaning it's not as easy to dispose of it, right? It's not as easy as well to arrive at a price that you would say reflects the market price, okay? Now, enter the REIT as an asset class, right? I always say REITs are a new asset class. And what is an REIT, all right? Now, by definition, an REIT or a real estate investment trust is a stock corporation established principally for the purpose of owning income-generating real estate assets. Okay, so now when you look at that definition, you would now have to compare an REIT as an investment vehicle, right? Listed and traded in the Philippine Stock Exchange, professionally managed with choice of valuable assets, delivering a steady stream of dividends, not just on an annual basis, but also medium, long-term, looking at capital appreciation depending on the REIT strategy, right? You compare that as an investment asset to holding the real estate asset, which is very liquid, as well as very much attendant with a lot of friction costs, holding costs, okay? So that is the beauty of an REIT. It provides an alternative and really is not a regular corporation, I always say. While it's called a real estate investment trust, the word trust there is really just adopted to align with the taxonomy or the term that is used across markets, right? But in this part of the world, it is structured as a corporation, meaning the shareholders, right, as and when it's listed, will have economic interest in the corporation's results of operations, right? As well as the shareholders will also have political rights, right? By nature, as a shareholder, you participate in the distribution of profits. That is your economic right, as well as your political rights as and when there are shareholder approvals. required. All right. So it's a corporation. It's not a trust. Nevertheless, we call it a real estate investment trust for convenience. Now, there are capitalization requirements. There are independent directors requirement as well. Going into the core concept of an REIT being professionally managed and well-governed. That is why if you look at the independent directors required, these are the directors who are not in any way connected with the issuer, right? And out of the total membership in the board of directors of the REIT, at least 1/3 or at least 2 directors, whichever is higher, will have to be qualified as independent directors, right? In short, the independent directors really are there to ensure that there's a proper balancing of all interests as and when decisions of the board of directors are made, all right? Now, letter D is a very important facet of an REIT, and that is the minimum public ownership, right? By law, by Republic Act 9856, the requirement as a minimum is that at least 1/3 of the outstanding capital stock of the REIT will have to be held by the public, right? In essence, it is so much higher than the existing 10% minimum requirement for companies which are already listed, whereas those which are going to do an IPO right now, the minimum is 20%. An REIT takes it a notch higher because at least 1/3 of its outstanding shares will have to be shared with the public. In short, it's actually another way to democratize ownership in these very valuable assets, which are professionally managed and delivering a steady income stream, all right? Now, management is also a very important feature of an REIT. We will have to engage a fund manager as well as a property manager. And these are the professionals that will run the day-to-day operations of the REIT in order to properly administer, manage its portfolio of income-producing real estate assets, not just on a short-term basis, but as well on a medium and long-term basis, okay? Now, whenever you look at an REIT, right, the story and the beauty of an REIT is because of the quality of its assets, right? When you say assets, the underlying asset of an REIT, right? This is what we call real property. Okay? Now, when we were in the technical working groups, when we were in the deliberations, both in the Senate and in Congress, we were posed the question, how will we define real property? Is it really just land, as it has been traditionally defined, right? As well as, for example, constructions over a piece of land, which are by destination incorporated into the real property, hence partake of the nature of a real property, right? So what we did was, okay, why don't we adopt a more general, holistic definition of real property? And so we referred to the definition under existing laws, in this case, the Civil Code, when it speaks about immovable property, okay? That it's expansive and actually is very inclusive in the sense that it does not just refer to the real hard asset, the real property or the land itself, but as well to such other properties that may either be real estate by incorporation, okay, other than real estate by nature, okay, or real estate by destination, right? And this makes it a very much, I would say, exciting field, because in the future, you could even have data centers, you could even have, for example, warehouses, and such other concepts that would partake of a real estate or a real property, right? The cloud, right now, when you talk about the cloud, that technically, right, as long as you're able to conform to the definition of real property under the Civil Code, and that could also be classified as income-producing real property. So very important, no? From the get-go, we made sure that it is expansive, inclusive, so that there would be as much leeway, as much innovation in this space, not just as and when it's launched, but for the foreseeable future, okay? Now, another important point is that there will be a public offering. Therefore, there will be what's called a required registration under the securities laws. Hence, with that comes what's called the prospectus or the REIT plan, the REIT plan. This will definitely have to be disclosed, not just prior to the public offering, but as well throughout the life of the REIT, okay? This will chart the strategy of the REIT. What is the mandate of the REIT? Is it to be only holding real estate assets with respect to office spaces? Or is it going to engage, for example, in hospitality, hotel REITs? Will it be engaged in infrastructure that's income producing and such other real estate related strategies? Now, all of these will have to be publicly disclosed via the REIT plan or prospectus, right? Again, I'd like to point out, it's always also important for us to look at the attendant risks, right? To any investment, there will always be risks. And the way you would have to appreciate it is that how will the corporation or the sponsor manage the risks pertaining to REITs? Because as we know, the volatilities that we're seeing in the market, whether it be driven by the pandemic or really as a function of economic volatility, will also be present in an REIT play. Therefore, those will have to be deliberately and carefully addressed, right, in the strategy for managing an REIT. Another important point when you look at REITs is the required mandated listing, okay? A REIT is required to register and list its shares in order to offer it to the public, okay? Now, the moment it does not comply with the listing or the registration requirements, then it will not be able to avail as a corporation of the tax incentives, right? The tax incentives actually tie in to the dividend policy. Why is that? For an REIT by law, the requirement is that out of its distributable income, at least 90% will have to be declared and distributed to the shareholders by way of dividends. What that means is that on an annual basis, there's an expectation of regular income stream by way of dividends declared and distributed by the REIT. Normally, in an ordinary corporation, dividend declaration is really a discretion, right, of the board of directors consistent with its business judgment, right? There is no mandate. Although there could be a dividend policy, you cannot really be entitled to dividends until and unless the board of directors decides to declare and distribute dividends in an ordinary corporation. Now, in a REIT structure, that is not the case because the REIT is mandated by law to distribute on an annual basis at least 90% of distributable income, all right? And I say that ties in with the tax and the fiscal benefits because in other markets, actually a REIT is what they call a pass-through tax entity, right? In the Philippines, that's not the case. In fact, we did have a very lively discussion with the Bureau of Internal Revenue 11, 12 years ago and the Department of Finance because they were saying, we don't have to structure it the way it's structured in the US and in other markets because we need the revenues, all right? So we thought, all right, let's as well find a solution. Otherwise, this bill proposal will never see the light of day. It will never be passed by the Senate because of the objections from the executive, right? So what we found to be a sweet spot or to be an acceptable solution was that an REIT will still be taxed with one exception, right? At a corporate level, there is a tax, except that it can avail of an additional tax deduction. What is that? The dividends that are declared will be included as an additional deduction. Dividend declarations or dividends declared are not tax deductible in an ordinary corporation. But by law, dividends declared are tax deductible in an REIT structure. Right? So you see that in exchange for the fiscal incentives, you're able to deduct that, and what remains will be subject to tax. If you declare 100% distributable income, then there's really nothing that will be subjected to tax, right? So in exchange for that fiscal incentive at the sponsor REIT level, there is as well a requirement to democratize ownership and distribute dividend income year in, year out. Okay, so that's really the benefit of an REIT. And again, from the sponsor's perspective, always because it's required to be listed, then it will have the facility, the convenience, and the price discovery of fundraising or accessing capital from the public, right? So access to capital is very much an advantage to an REIT. Why? Because real estate demands capital expenditure, demands recurring cash inflows simply because you're running the business, right? And the fact that you're able to fundraise at a cost-efficient price would offer you a lot of advantages when you look at strategy implementation from an REIT perspective, all right? Access to capital, substantial tax benefits, as I mentioned, right? While it's not a pass-through vehicle, the way I explained it is still it can avail of additional deduction by way of the dividends that are actually declared, being, again, additional deduction for tax purposes. All right. As well, no IPO tax, initial public offering tax has already been repealed, but 11, 12 years ago, that has already been removed by virtue of the provision in Republic Act 9856. It will not attract an initial public offering tax. All right. Again, another point is that when you transfer real property, okay, from, let's say, an idle real estate asset, and you want that to be the underlying asset for an REIT, therefore, you normally would do that at the incorporation stage. Now, that would be structured so that it is what you call a tax-deferred or a tax-free exchange. And it's very clear now, under the law, as amended, the tax code, that this will now be exempt from the value-added tax. In fact, that was one of the pain points 11, 12 years ago, back in 2009, that also stunted or prevented the birth of REIT. Because then the BIR took the position that, okay, while it is income tax deferred, income tax free, that does not mean there is no value-added tax, right? So the 12% value-added tax was slapped. Therefore, corporate sponsors were saying, this would probably bring up the cost to a level which would not be viable, right? And so again, eventually, the tax laws were revised so that it's now very explicit. A tax-free exchange, whenever there's a property transferred to a corporation under the tax code, will not attract the value-added tax, okay? Again, there's also another tax benefit, 50% discount on the documentary stamp tax, pretty substantial when you transfer the property, similar to other legislation. We just adopted this from the other existing legislation, all right? Another benefit, really, you're looking at the market-driven valuation, right? You're able to realize the optimal price based on the wisdom of the market, right? It's more transparent. There's price discovery. And again, depending on the efficiency of markets, right? When you disclose material information for the benefit of the public, then that would guide them in their investment decisions, really arriving at a market-driven valuation for the REIT vehicle, all right? That's very important. And two more benefits, really, corporate governance requirements. I said there are higher than normal, higher than regular corporate governance requirements embedded in the REIT law, right? Again, it's going to be under the microscope, not just because it's availing of fiscal incentives at the corporate level, but it is now a public company, listed company. Disclosure obligations will have to be front and center with respect to ensuring that information that's material for investment is shared. Transparency as well allows the REIT to attract not just the local investors, but also global funds and global investors. All right. And finally, as you look at an REIT, the sponsor is required to have skin in the game, really, right? You invest because of management. You invest in a corporation because of the sponsors themselves, right? You believe in the vision of the sponsors. Therefore, with the provision in the law being reflected in the SEC IRR, right? At just really minimum 1/3, you can go up to a higher public float, but you're giving the option now to the sponsors to retain up to 2/3, right? This was, again, a pain point back, although that was clear in the law, it was embedded in the SEC implementing rules that over a period of time, the public float will have to go up to 2/3, right? So that was probably a deal breaker for sponsors, right? You have crown jewels, you have choice, valuable assets. Can you imagine? I'm going to tell the sponsor, when you invoke the provisions of the REIT law for fiscal incentives, eventually you will just hold 1/3, 33% equity ownership in that income-producing choice asset, right? That probably is a big letdown to the sponsors, right? Over time, again, we were able to address that. In fact, in 2020, the SEC revised the regulations to reflect what is really just included in the law, and at least 1/3 to allow investors to participate. At the same time, the sponsors to retain their skin in the game, right? Why? The REIT sponsor will be allowed to continue managing the assets through professionals that it would engage, the fund and the property managers. Again, may be related to the sponsors. However, there are corporate governance requirements at the board level to make sure that decisions, although these could partake of related party decisions, for example, are adopting corporate governance standards for the benefit of all the stakeholders, okay? Now, going to investors, why even consider REITs? Well, it's very clear that this is an asset that will allow you to democratize all of these high value real estate assets, right? Very high cost, very expensive. Now, because they are now listed and traded in the Philippine Stock Exchange, ordinary retail investors can actually partake of these high value real estate assets. It's a democratization of access to capital, access to choice asset. Otherwise, it would be pretty impossible, right, for an investor to probably become a shareholder of a joint venture where there is an income-producing real estate that is giving what, 5-6% dividend yields, right? That is not listed. That's why the REIT opens up the doors for us investors to become part owners or stockholders of an REIT, all right? Second advantage to us investors, it provides competitive, right? As we see, probably comparing to the risk-free rate, okay, on a 10-year basis, probably you're looking at for the Philippines anywhere from 3.9 to 4% as they are currently now. In the US, you're looking at anywhere from 1.5 to 1.6%, 10 years issued by the treasuries. Compare that to an REIT. Probably you're getting 4, 5, 6% by way of dividend yields. And on a total return basis, you expect to get more, right? On a long-term basis because of the capital appreciation. And over time, additional real estate assets being infused, injected into the REIT. Hence, it's competitive, stable, and total returns are very, very attractive, right? Not to mention, as earlier mentioned, right, provides for an inflation hedge and really also provides for actually a pretty low correlation to other investment vehicles, all right? So competitive returns, not just on the yields, but also on a total return basis. What else? To us investors, it's very important that you have investments that you could easily monetize, right? When you decide to exit, there is liquidity. And so if that were real estate, you're holding on to the underlying real estate, it's not as easy again to sell real property, especially the more valuable ones, especially in terms of time and in friction cost. That is not the case for an REIT because just like any other listed share of stock, there is liquidity and the tax that would be attracted is really just 60 basis points when you sell, all right? There will be no documentary stamp tax when you sell. Of course, when you do a primary issuance, when you buy from an IPO, there could be documentary stamp taxes. But in short, the liquidity benefits, the advantages in terms of the low holding and the very low friction cost will actually be a game changer compared to the real estate asset. Holding on to the underlying real estate really would not compare to all of these benefits for an listed REIT. Other benefits to investors. Well, portfolio diversification. Now you're getting exposure to real estate, not just through the property companies, right? We have listed property companies, but here you're looking at an income-producing real estate company that would deliver all of these yields and really to allow you to diversify your portfolio, right? Again, low correlation to other asset classes. It's very much an incentive. Now, when you look at pandemics, you look at economic shocks, market cycles, you'd like to hold on to a safe asset, right? And we have seen that through the years, it has outperformed, right? If you look at other jurisdictions, not just the benchmark index, but also provided for that extra kicker when you look at the peaks and the troughs of market cycles, all right? So portfolio diversification, very much an advantage to investors. Professionally managed real estate, of course, is a feature, a must-have for an REIT to the benefit of the investor. And finally, this is what is also peculiar to the Philippine REIT framework, not only because of the requirements for transparency, but also the investment will have to be structured in a way that it is all the way up to the beneficial owner. This is what we call the name on central depository framework, right? You don't have to worry about it. The REIT eligible brokers would already make sure that the structure is in place so that when you decide to participate, whether in an IPO or to buy in the secondary market, that NOCD framework with the Central Securities Depository, the PDTC, will be to your advantage. There's more transparency. You could check the balance of your REIT account yourself, just like you would when you are engaged in online banking, for example, right? So that structure is really investor protection, the NOCD framework, harping on the fact that, in the end, empowering investors means access to data is being given to them on a real-time basis as well, all right? These are the benefits to investors. And let me end with this very telling graph with respect to the performance of REITs in our market vis-a-vis, for example, a main benchmark index, the PSEI, vis-a-vis, for example, the property sector, property index, right? Now, so far, we already have 3 REITs. There are a couple more in the pipeline. But what you're seeing here is that, for example, the REIT, the first REIT, A-REIT, is really outperforming not just the PSEI, but also the property index, as well as the other sectors when you look at a total return basis, right? And this is very compelling simply because it is behaving as it is behaving in other markets, right? It's a very important innovation in our capital markets. And I always say it was a long time coming. It was 11 years in the making. But as they say, right, the best things are the ones that take time. Nothing ever came easy. And we hope that you would consider participating in the REIT journey. And this is really just version 1.0. The best is yet to come. When you look at other real estate assets, there could be an evolution, right? When you look at the REIT structure, there's now innovation. When you look at real estate underlying the REIT, it could go not just to the real estate, the property itself, it could go as well to data centers, infrastructure, hospital REITs, right? Hotel REITs, malls being REITed, a lot of potential upside for REITs. And I would like to just give you the key takeaways when you look at REITs. Number one, right? At the very core, it will enable economic development, right? People will say, oh, it's beneficial to the sponsor, beneficial to investors. What about the economy? The simple answer is it will redound to the benefit of our economy, right? The multiplier effect is something that is really observed as we have seen the REITs already being launched in our market. As well, it also optimizes real estates which are otherwise idle or really not deriving the value that they would if they were structured as an REIT. Again, also competitiveness of our capital market amidst the so many jurisdictions which have already offered this years before and now continuing to offer more and more iterations of the REIT. Okay? So economic development, first key takeaway. Second is that it's structured as an REIT, not as an ordinary corporation. It's structured according to the law with respect to the professional managers, with respect to the, essentially, there's a special purpose vehicle holding the real estate asset to benefit both issuers and investors. Okay? There's a bilateral benefit to the to the participant, the investors, together with the sponsors. In exchange, sponsors are required by regulations to reinvest within a period of 1 year everything that they're able to fundraise in an REIT offering. All right? Now, tax efficiency, very much central to an REIT. Beneficial not just to sponsors, but as well to investors because of the listing requirement. Okay? Now, evolution of REITs, we're looking at more and more ESG, environmentally sustainable REITs. And we're looking at LEED certified buildings, right? They're using algorithms, data analytics to be able to measure waste management, right? How are they able to engender recycling for the tenants? Really, this is more than just a fad. When you look at ESG, you know, E for environment, S for social, G for governance, right? An REIT is a perfect fit for an ESG theme because, again, real estate does contribute to probably the carbon footprint. And so those which are more advanced, issuers, sponsors, would be taking this to heart and embedding an ESG strategy simply because it is good in the long term for everyone, right? Not just the stockholders, not just the sponsor, but for our planet Earth. In essence, it's really has to have, not just a nice to have. And finally, the future, right, is still very much open-ended, right? Our story is still being written with respect to the REIT. And we hope that as we progress, that you also participate in the journey as investors, simply because this is a product that you just cannot simply set aside, give and take all of the benefits and give and take all of the options that are as well available to you. So with that, I'd like to thank you for taking the time to listen to the REIT story and see you around as we embark on the REIT journey, not just now, but as well in the next succeeding years.
Thank you so much, Attorney Roel, for your presentation. As you mentioned, impossible to ignore. This product is here and now. And we will, of course, get back to you and to Derek shortly for our panel discussion. For now, let's check in with our panelists and also see what they have to say about the knowledge sharing we've had today. So I just want to reintroduce them.
Peter Bautista here is the head of the Sales and Distribution Group at First Metro Investment Corporation and also the host of The Trading Room, a series of insightful and informative conversations with the country's foremost executives, policymakers, and market movers. And Marco Tarog is a Market Education Officer of Business Development at FirstMetroSecurities Brokerage Corporation and regularly hosts and advocates financial literacy webinars and market education regularly published at the Facebook page and YouTube channel of FirstMetroSec.
So, good morning, gentlemen, and welcome to, of course, our broadcast here. I think that was a lot of food for thought. First, we had, a developed market perspective, from the Singapore side, and you've got now something that's just kicking off, the Philippine side. Let's hear it from Peter first. Initial thoughts about, these two presentations. What were the surprising aspects about it? How can you compare those two types of markets?
Okay. Good day, everyone. Thanks, Danie. What more can you say with the two presentations, right? I mean, first off, we were shown how, as an asset class, REIT is an established investment option, if not a preferred one. We were shown that REITs have performed, how it's performed, and how it has outperformed with all the ups and markets of the markets the past few years. I especially like how Derek pointed out that big is better, that definitely there is a premium to size and how size can help you continue to accomplish and improve. I like the view also that inflation and with rates in inflation going up, it's good that people get this appreciation where REITs come in and the relationship with the two data sets. Of course, Attorney Roel's recounting of the REIT journey, the benefits and performance, it's quite epic. If the way I heard it's quite epic. Perfect anecdote that good ideas will eventually prevail in spite and despite of the headwinds. I have nothing but congratulations and thanks to Attorney Roel, Mr. Monzon, the PSE, and everybody who fought the good fight to bring REIT to our shores. Quite optimistic, Danie, that with how REITs straddle asset classes, debt, it's a little equity. It's a lot equity, actually. It gets the best of both worlds in terms of income stream, liquidity, asset appreciation. Good option for people looking for a home for their cash. Finally, the REIT. We only had a REIT last year, but since then, it's grown. It's grown. Names have followed, and there are names in the oven. And as Attorney Roel pointed out, the REIT story is still being written. And personally, I can't wait to read the next pages. Ika nga ni Attorney Roel. Thanks, Danie.
Thanks, Peter. You did mention that everything seems to be very interesting for this story, and it's quite curious to think that why did it take 11 years for us to finally have a product that doesn't seem to have any real flaws, at least from the get-go, diba? Marco, what's your insight here? And you've been following this product for a long time, I'm sure, as most of the capital market players. What are the new learnings that you've had from these two presentations that you were not really aware of before?
Well, thank you, Danie, for queuing me in. But I'd like to thank first Attorney Roel for the presentation, and of course, Derek. We're very, very appreciative of your time. So I'd like to echo Peter's sentiments that the presentations of both speakers are very, very full and comprehensive, and it's quite hard to focus on one specific topic. But I'd like to take the chance to contribute and share some of the things that I get asked about REITs to our esteemed presenters now. If it's okay, I'll start with Attorney Roel. One of the things that I get asked a lot about REITs is on the net income of these vehicles. We see a lot of people mentioned net income, 90% of net income that has to be distributed. But from your presentation, you made it a point to highlight that it is distributable income, right? And in your slide, I believe you described it to be net income adjusted for unrealized gains and losses and impairment losses. But in simple terms, just so that we can have clarity on the issue, for every, let's say, 100 pesos in net income that a REIT may register, is the company obligated to distribute all 90 pesos in their net income, or can a REIT, let's say, retain a portion? In our example of the 100 pesos, can they, let's say, retain 50 pesos for capex and working capital? And then will the 90% apply to the remaining 50 pesos? So I appreciate it, Attorney Roel, if you could further clarify this for myself and for all the partners and clients that usually ask this question.
Okay, so I think at this point we'll bring back our speakers, no, Attorney Roel and Derek. Please, if you could join us here for this very insightful conversation. So go ahead, Attorney Roel, with that specific question from Marco.
Right. So that's a very important question, Marco. When you look at an REIT, it's unlike, as I mentioned, unlike other corporations where you could really just come up with reasons not to declare dividends. So I'd say an REIT is a different structure. By law, it's required. As long as you're able to show that you have distributable income, then for you to continue enjoying the tax benefits, right? If you feel that, okay, I don't think I don't need the tax benefits anymore, then the moment you do not comply with the legal requirements, then that's when the tax assessments would come in. Because you're only, you can't just enjoy the fruits and not partake in the pain, right? You have to share with the stakeholders because that's a legal requirement. So whenever the Bureau of Internal Revenue would take a look at your compliance, not just with the tax regulation, but also with Republic Act 9856, that's the first thing that they would check. Did you declare out of distributable income at the very minimum 90%? If you do not tick off that mark, then you are at risk of being assessed because you continue to enjoy the tax structure where you are being taxed at a lower level, right? When you contributed the property, there was 50% DST, only documentary stamp tax. You availed of the VAT-free, tax-free exchange. So all of those will also be assessed against you by the BIR if you do not comply with the 90% minimum distributable income declaration of dividends, right? So it's a legal mandate, Marco. It's not so much elbow room for sponsors to just disregard that legal mandate. Unlike in an ordinary corporation, because in an ordinary corporation, really, you could decide to defer distribution of dividends, right? During the COVID pandemic, we saw dividends about to be distributed, given a record date, suddenly being revoked, right? That was a very extreme measure because they needed to preserve cash. Not so with an REIT, because the income story of an REIT and the beauty of an REIT is that it's supposed to provide steady yields, steady dividends by way of the income-producing real estate asset.
Derek, maybe you want to add to that. Is this standard practice in other countries as well? And is this something that is sustainable, for the sponsors as well to keep distributing 90% minimum dividends?
Okay, I think in Asia and especially from Singapore where I am, the 90% payout ratio has been maintained for the past 15 over years. In fact, most of the REITs pay out 100% of their cash flow. So I think it's important to note that whatever distributable income that the REITs pay, it is backed by actual cash. And whatever non-cash items like revaluation, impairments, these are disregarded. So what does it mean for investors is that for a REIT, you have to take a very close look at the financial matrix like gearing, interest cover, because you have to pay interest, you have to pay the banks. So gearing level typically is low. So I think in the Philippines it's 35% limit. Singapore is 50. So these are some of the key things to look out for. But the COVID has also taught us many lessons. So for the first time in let's say 15 years, the regulators allow the REITs to not pay the dividends for just 1 year. So I think, Attorney and Roel, we mentioned that some companies last year they had to retain cash. Last year, yes, some REITs have the opportunity to not pay dividends for 1 year, but on one catch. Whatever you do not pay this year have to be paid in the following year once economy recovers. So this tells us that in a longer term, investors are not shortchanged, but in fact, whatever that is owed to you in terms of the cash flow dividends will be repaid in time. So I think give investors a lot of comfort about the REIT as a structure.
Okay, Attorney Refran, I think you may want to add something here if that's going to be a possibility as well here in the Philippines, huh?
Well, it's interesting, Danie, when you look at the REIT story. It was 11 years pregnancy, I would say. But the delivery of the baby happened during the pandemic, no, Derek? It could not have been a worse time. From my perspective, I've seen it from 2007, 2008. Can you imagine, no? This was your baby, and now it's being delivered in the delivery room when all hell is breaking loose. No? But what's interesting is that, that being said, still the performance of the REITs has been pretty competitive. No? Of course, nothing is guaranteed. But nevertheless, the pipeline is very robust when you look at the listed issuers. And I can only imagine what other strategies they could probably implement in order to further improve the total returns for the investors. No? So will that be a story as well for the Philippines? Well, we hope not, because it's really a very upbeat, I'd say, upbeat industry when you look at the REIT right now. If we were able to weather the pandemic with the first delivery, I think we probably would be in better shape because the real estate story of the Philippines is also, some people are saying it's a lot of investors maybe holding on for purposes of using, but there are also a lot of investors that are really speculating, right? So rather than speculate with the real estate hard assets, I think this is a very liquid asset, right? Very highly regulated. As Marco was asking, what about the dividends? There's now the government and the regulators looking over their shoulders. Make sure you comply with the terms of reference. Otherwise, get out of this REIT story. You're just getting the dividend. You're just getting the benefits. That cannot be the case. So I hope we see this story unfolding the next chapters. It's now going to hopefully evolve, like Derek mentioned. A lot of mergers happening in the advanced jurisdictions. And really, the concept of real estate that we adopted from the get-go, I think, is something that would be more inclusive than if we simply defined it to be limited to land. Real estate is not land by definition under the REIT law. Real estate can be those which are immovable because they were incorporated, those which are immovable because they were destined, attached, and it could be any other quote-unquote real property other than the real land itself, right? So that's what I hope will happen for our REIT story.
Okay, Peter, do you share the same optimism that with the current regulations and even the structure of the REITs, we will have, of course, successful issuances and investors will continue to be interested in this? And do you have other questions with regard to the structure when it comes to the regulations that have been put in place after 11 years?
Yeah, thanks, Danie. Notwithstanding, I'm part of some of the transactions that are being peddled out there, but I think the market's looking for novelty and an instrument that they can put their cash in that's safe, quote unquote, that pays the right returns, that affords them a measure of safety, of liquidity. It's that. But thanks for asking that. It actually leads to my next question for Derek. Derek mentioned about REITs and its correlation to inflation and the effect of the predicted higher interest rates. Derek, your thoughts, please?
Yeah. So I think it's been proven that over time, in higher inflationary environment, people want to buy real estate. So I think for the average man on the street, how hard is it for you? I mean, it'd be a bit more difficult for you to say to buy a residential property, or if you like commercial, you like data centers. Some of these assets are really out of reach. And what I've also noted is that because of low interest rates environment of past 10 years, the inflation that we are seeing is in real estate, although we're not seeing it in other ways. So I think a lot of funds are going in and investing in the sector itself. So what we have noticed is that for the transactions that we are seeing, returns have been compressing. For example, 5 years ago, you could easily get 5 to 6% for a data center in Asia. Now you probably have to pay sub 5, for example. So then I feel that will translate to how REITs, their asset values will increase over time and NAV will increase, and generally that also will result in higher prices if your asset value continue to increase. Then on the flip side, interest rates, we talk about the negatives. We also see the positives. Negative naturally is that when you go to the bank, they will tell you that, hey, my interest rates have rise, and you will have to it costs more for you to maintain your loan. Naturally, that will be a dampener to distributions, but not if, let's say, for example, my revenues have grown at a rate that's even more than the interest rate increase. So I think this is something that investors always look at just one point, but we have to look at it broadly. If a REIT can continue to grow at a dividend, if, let's say, revenues increase, outpace that of interest rates. So that's important to consider. Do not look only on the headline yield, but also consider the growth in the dividends and how sustainable it is.
I think the $1 million question is, where is the Philippines in the market cycle right now, and where are we headed? No, Marco, I think you have a similar question related to that in terms of economic cycles and how that relates to yield, whether we can expect the same cycles to be happening here in the Philippines compared to Singapore. Maybe nuance your question a little bit.
Yes, thank you. I think we've been observing that there is some price discovery happening in the Philippine REIT market. We've seen it with the A-REIT last year when it was launched and debuted on the stock exchange. It took a couple of months for it to really take off. And I think the same thing is happening for the recent offerings. Derek, I'd like to take this opportunity to ask you what you think about how REITs can perform in, let's say, different economic cycles as compared to, let's say, growth stocks. Not a lot of investors are neither familiar nor have found interest yet, because I think they're still in the process of understanding. So your insight will be very, very valuable with your experience in the Singapore market. And relating this to your point earlier, that a lot of it has something to do with the sector in which the underlying income generating assets belong to. So could you give us some insight as to how REITs perform versus, let's say, cyclical stocks during different phases of the economic cycle? Thank you.
Okay, thanks, Marco, for the question. I think we can't avoid from the fact that in early economic expansion, at this point in time, after a recession last year, naturally investors will want to go to look for cyclical stocks, and because they're probably trading at a good discount to their own historical trading bands. That is something that we saw this year for a developed market like Singapore. However, I feel like for Philippines, it's a little bit different. Using my experience, if I were to look back to 2005, 2007, when we were covering the sector back then, REITs in Singapore were deemed to be growth stocks. And the main reason is because the dividend growth back then was on average between 5 to 10% per year. And it's driven by many, many different reasons. One, because of better economic prospects, landlords were pricing up the rentals when leases come due. So you got that dividend growth, what we call as organic growth perspective. And what I feel very interesting for the Philippine market is that if you look at the new issuers, the gearing is almost zero or very low versus what is available as an optimal level. It's what in Singapore, we're very comfortable with a gearing level of about between 30 to 35% or 10% below our limit. And if I take Ayala REIT as example, based on my observation, since listing is up about close to 30%. And I think it really, really run after a while when they start to deliver that acquisitions. Investors start to understand that, hey, apart from just rental uplift, this Ayala REIT has been acquiring assets, and my dividend growth is even faster than my initial expectations. So I think that has caused investors to get more excited post-listing. And I feel that the opportunity for the Philippine REITs will be that, you need to combine a good combination of both organic growth, running on the back of better economic prospects, and then at the acquisition angle. If you have that 10 to 15% growth in dividends, I would dare to say that the Philippine REITs you can put them together as a growth subsector.
Okay, and I think Peter has a question to add to this discussion as well, directed to Attorney Roel. Go ahead, Peter.
Attorney Roel, we talked about 11 years before your kid got out. Sir, throughout the 11 years, what was the turning point where you thought and felt it was coming out already, that it was it, this was it, this was the time? What was the turning point, sir?
Right, right. The law was structured in a way that we thought it was already self-implementing, right? For us lawyers, there's always the law that you don't need an IRR for, right? But executive departments had a different view, unfortunately. So we back in 2012, 2013, they came up with the regulations, which essentially amended, right, what is already in the law. But nevertheless, the minimum public float of 1/3 was revised to 67%. That was a game changer, right? And so we were making representations with the lawmakers. I was a regular in the Senate as well as in Congress, just telling them, can you just withhold the budget for these institutions, because they're really aborting this baby, right? It's really aborting what is to be a very exciting times in our capital markets. So Peter, when we change administrations, right? We have the current administration that was in 2016. It took us some time to warm up because we felt that this is now when we should make the push. And so the public float was addressed at the same time as the value-added tax issue, right? So direct, the way it's structured here is unlike in Singapore, right? The transfer will have to precede the public offering, right? The use of proceeds will not be in order to fund the injection of the assets, unlike in Singapore. Because of regulatory requirements here, you have to incorporate first, inject the asset during incorporation, avail of the tax-free income tax structure, and the Bureau of Internal Revenue assessed VAT there, right? That's 12%. That was very painful. Can you look at this billion peso assets? In 2020, before 2020, we had a dialogue with the Department of Finance, and truth be told, it seemed that they were really just saying, okay, let's do this, but include a domestic reinvestment requirement. That seemed to be, Peter, the turning point. So we felt, let's adopt that 1-year domestic reinvestment requirement. They felt for all the benefits, you have to commit to domestically reinvest. Let's make that a requirement. When we said yes to that, we were able to gather everyone and really sign off on the final regulations. I still distinctly remember that, January last year, right? We had very, I say, short time to prepare, but it's been 11 years to prepare. So I said, let's go for it, right? So again, I also wanted to ask, I wanted to add rather, when you look at income, bonds will not be comparable to equity income in our part of the world because of the tax arbitrage. When you look at dividend income, you're only slapped with a 10% withholding tax. If you look at bond income, let's say you invest in a corporate, you'll be taxed with a double 20% passive income tax. So there's that in-net arbitrage, I call it, the tax arbitrage. So really for us investors, on a net basis, right, give and take all the options available, you really would probably be missing out on this very important story if you still think this is not a very good investment product.
Thank you, Attorney Roel. Guys, we don't have much time, but I think just to close, I do have one question that I think all of you can weigh in on just for a couple of minutes. And that is, I think there is this, positioning of REITs in between everything, right? It's quite like a bond, but then Derek is saying it's a growth stock. It's something defensive during COVID, but at the same time, it's a long-term growth, story. You need to hold it for a while, but it's also liquid. Tell me, how do investors make sense of this, and how do you treat a REIT? Is it high risk? Is it something that you do during these uncertain times? So maybe Peter, you can start, and then we go through the floor.
Yeah, thanks, Danie. I've been selling for a better part of something years, X number of years. I think there's a product for everybody. There's a right product for everybody, and every security basically has a place in everybody's portfolio. What's nice about REITs is it actually gives, like you said, it gives everything that a client would normally ask for. The security is there, the stream of income is there. So it I think it straddles a lot of markets. And like I said, it could be just a function of asset allocation. The heavier, the ones who are into more risk can just add a little more. Vis-a-vis the others will probably use this just as a base for their portfolio. But at the end of the day, I think REITs is an instrument that traverses across the classes and across the risk appetites of our investors.
Okay, thank you, Marco. Your turn.
Usually, when we talk about REITs, when I get asked about REITs, everybody talks about the dividends. Everybody talks about the potential for price appreciation. But what I'd like to remind everybody is that at the end of the day, they are common shares of stock, and they do belong to equities. And in that definition, they are a more volatile asset. They're a risky asset. So in terms of placing it between different types of asset classes, I would say it's a good option to get your feet wet into the world of equities, as it will provide cash flow and income. But again, let's classify it as something suitable for aggressive investors. And I think that's something that we have to remind viewers that at the end of the day, it's not a bond, it's not fixed income, it is equities, and there is still that level of volatility. So with that, I'd like to just ask if this is a suitable classification or definition for those learning about REITs for the first time here in the Philippines to everybody. Thank you.
Thank you, Marco. Derek, your insights.
Okay, thanks, Danie. I guess for REITs, from where I'm from, I think it's a good balance of both dividend and growth. I would put it in between, both bond and equities. In fact, I lean it closer to equities by virtue of the volatility it has. But the sector has been time tested, so we have been through many crises, and after each crisis, you'll find that the volatility to economic cycles have lessened over time. So it's also tell us that while things are volatile, it is much more stable by virtue of having a track record already. So I said for investors, new and old, very seasoned or maybe new to REITs, I think it pays to be having it as a core part of your portfolio. It pays you a very good dividend, 5-6%, for example, and then in whatever dividends you can clip, you can then use it for your more aggressive kind of investment asset class. So I always felt that for REITs, it will form a very core part of both institutional or even for private wealth portfolios.
Thank you, Derek. And finally, let's hear it from the proponent of REITs himself. What type of definition you would give this and what type of regulatory classification?
Well, the REIT definitely is probably riskier than bonds, right? When you look at bonds, they're contracted cash flows. This is not a case of contracted cash flow. However, that being said, when you look at equities, you're probably toying between preferred shares and common shares. Now, are you better off holding on to the preferred shares? Some people will say yes. Some people will probably say, well, despite all the beauty of a preferred share, there are as well embedded options when you look at preferred shares. There could be a stop with respect to your income stream because of the call option and redemption feature. That's not present in an REIT because the law will step in. The law says, make sure you declare dividends, lest you lose the tax preferred, you lose the fiscal incentives, right? And I think we have to open our eyes to the fact that really in other parts of the world, it's been a steady provider of yields, right? Yes, it does provide for risks. That's why you always look at how is management, how is the board of the REIT managing all of these risks? Because at the end of the day, they have to be competitive, right? We cannot just have the same REIT over and over launched multiple times. It has to be something that's innovative. It has to cater to the needs of the markets. And I think that's where the story would eventually go for us with the likes of, your team in First Metro, both on the investment bank side as well as on the security side. I think that's where we're able to generate innovative ideas to really make this. This is going to go through teenage years. It's not going to be a baby forever, right? It's going to grow up, it's going to learn, it's going to fall, it's going to hopefully become a very productive member of our capital markets, as it is already promising to be. So I think it's going to be taking a village to raise this baby, not just a couple of people. So with that, I think we're in this together, everyone. And exciting times ahead for everyone.
Thank you so much. A lot of evolution ahead, and of course, a lot to be looking forward to. Thank you so much to our panelists, of course, and speakers for that lively discussion today. I know all of us are bringing some valuable lessons from today's knowledge. So we hope that this discussion today makes your stock trading journey more meaningful and valuable, and that all your learnings today help you guys as you traverse the market with more purpose. So thank you once again to our presenters. We have Derek Tan, Attorney Roel Refran, and of course our panelists Peter Bautista and Marco Tarog for sharing the gift of your time today with everyone here. So I'm Danie Laurel, and thank you for watching the Philippine REIT Landscape presented by First Metro Securities in partnership with the Philippine Stock Exchange and DBS
Group Research.
Start your investment journey today with FirstMetroSec. Here's how to open your account online. First, go to the FirstMetroSec website and click Open an Account. Select whether you're a MetroBank account holder or other bank depositor. For a seamless application, prepare these requirements in advance. Tax identification number or TIN. An active email address. Valid ID with 3 signatures on a white paper. Proof of bank account and proof of address. For non-MetroBank account holders, a PRC ID or a driver's license is required. You must also make an initial deposit of at least 5,000 pesos or $100 US, which you can use to invest in stocks, funds, and bonds. There is no maintaining balance required. Once all of the requirements are prepared, you may proceed. Next, completely accomplish all the online forms. Once done, you will receive an email verification. Just click the link on the email to proceed. Then, upload the required documents you've prepared. And that's it, you are now done with your application. Note that it will take 2 to 3 business days to activate your account. Once your account is activated, you can access your FirstMetroSec account through your desktop or laptop, tablet, or phone through the FirstMetroSec Go app. For more information, visit our help center at help.firstmetrosec.com.ph. All the options and convenience within your reach through International Finance's best online broker and best online trading platform for 4 years in a row. With FirstMetroSec, it's your future first.